Picture this. Somewhere in a secure building, a central banker sits at a computer terminal. They type a number. Maybe it's $1 million. Maybe it's $1 billion. They hit enter. And just like that, money exists. Money that wasn't there a moment ago. Money that didn't come from anywhere. It simply appeared because someone with the right authority typed it into existence. This isn't science fiction. This is exactly how most money in the world is created today. And once you understand this system, you'll never look at your bank account, your paycheck, or the price of groceries the same way again. Let's start with something most people believe. Most people think money is printed by the government, backed by gold sitting in a vault somewhere, and that banks are simply safe places to store this physical money. Every single part of that belief is wrong. And it's been wrong for a long time. Here's what's actually happening. When you go to a bank and take out a loan, let's say $50,000 for a car, you probably imagine the bank is lending you money that someone else deposited. Maybe it's sitting in someone's savings account, and the bank is just acting as a middleman. But that's not what happens at all. When the bank approves your loan, they don't go to a vault. They don't transfer money from someone else's account. They literally create new money by typing numbers into their computer system. The $50,000 you just borrowed didn't exist anywhere in the world 60 seconds ago. The bank created it with a keyboard entry. You drive away with a real car, purchased with money that was conjured from nothing the moment you signed the paperwork. Now you might be thinking, that can't be legal. That sounds like counterfeiting. But this is exactly what banks are licensed to do. It's not a conspiracy. It's not a secret. It's the foundation of our entire monetary system. And it works through something called fractional reserve banking. Here's how fractional reserve banking works. Imagine you deposit $1,000 into your checking account. You think that money is sitting there, waiting for you. And in a sense, it is. You can withdraw it whenever you want. But the bank doesn't actually keep your $1,000 in a vault. Instead, they're required by law to keep only a fraction of it, usually around 10%. That means they keep $100 and they're free to loan out the other $900. But here's where it gets really interesting. When they loan out that $900 to someone else, that person usually deposits it into their own bank account. Now there's a new $900 deposit. And that bank keeps 10% and loans out the rest. This process repeats over and over. That original $1,000 you deposited can eventually become $10,000 circulating through the economy. Money has been multiplied through the magic of fractional reserves. Most people walk around thinking there's way more money in the banking system than actually exists. If everyone tried to withdraw their money at the same time, the entire system would collapse immediately. Banks simply don't have the cash. This isn't a flaw in the system. This is the system working exactly as designed. Think about what this means for a moment. Your sense of financial security is based on the assumption that not everyone will want their money at the same time. It's a collective act of faith. The moment that faith breaks, the moment people start to panic and rush to withdraw their deposits, the illusion shatters. We've seen this happen throughout history. They're called bank runs, and they're terrifying precisely because they expose the truth that the money people thought was safely stored away never really existed in the first place. But commercial banks creating money through loans is only half the story. The real power sits with central banks. In the United States, that's the Federal Reserve. In Europe, it's the European Central Bank. In Britain, the Bank of England. These institutions have an even more remarkable ability. They can create money without any deposits, without any reserves, and without any limits except their own policies. This brings us to something you've probably heard about but might not fully understand. Quantitative easing. The term sounds technical and boring, which is probably intentional. But what it actually means is breathtaking in its simplicity. Quantitative easing is when a central bank creates new money and uses it to buy assets, usually government bonds or other financial securities. Let's break down what happened after the financial crisis of 2008. The economy was collapsing. Banks weren't lending. People were panicking. So the Federal Reserve decided to act. They created, and this number is important, over $3 trillion. Not $3 trillion that they had saved up. Not $3 trillion they borrowed from somewhere. They created it digitally, out of nothing, and used it to purchase bonds and other assets from banks and financial institutions. Think about that for a moment. $3 trillion, typed into existence. If you or I did something similar, we'd be arrested for fraud. When the Federal Reserve does it, it's called monetary policy. And this wasn't a one-time event. During the pandemic crisis of 2020, they did it again, creating trillions more in a matter of months. The speed and scale of money creation in recent years would have been unimaginable to previous generations. Now you might be wondering, if they can just create money whenever they want, why does the government bother collecting taxes? Why do we have national debt? Why doesn't the central bank just create unlimited money and solve all our problems? Why are there homeless people on the streets if we can simply manufacture money at will? The answer to that question reveals the fundamental truth about modern money. Money is valuable only because it's relatively scarce and because people trust it. If a central bank creates too much money too quickly, that trust evaporates. Each individual unit of currency becomes worth less. Prices rise. This is inflation. And inflation is often called the hidden tax because it quietly erodes the value of every dollar you own without anyone officially raising your taxes. Here's something that will change how you see government debt. When a government borrows money today and inflation happens over the next decade, they get to pay back that debt with money that's worth less than when they borrowed it. Imagine borrowing $100,000 when that amount could buy a house, and then paying it back decades later when that same amount barely covers a car. The government benefits enormously from inflation. It's one reason they're rarely in a hurry to stop it. But while the government wins, ordinary people lose. Wages almost never rise as fast as prices. Your paycheck might go up 3% while the real cost of housing, food, and healthcare goes up 7%. You're getting poorer in real terms, but the statistics say you got a raise. The government can claim they're helping workers while those same workers find it harder each year to afford the basics. And here's the cruel twist. Inflation doesn't hurt everyone equally. The wealthy own assets. Real estate, stocks, businesses, commodities. When inflation happens, asset prices generally rise. The rich get richer simply by holding things. But poor and middle-class people hold cash. Savings accounts, fixed incomes, paychecks, and cash loses value every single day when inflation is running. The system punishes savers and rewards debtors, especially powerful debtors like governments and corporations. This brings us to a truth that sounds almost philosophical but is actually mechanical. Every single dollar that exists is someone else's debt. Look at a dollar bill if you have one nearby. It says Federal Reserve note right at the top. A note is a debt instrument. That dollar is technically a promise, an IOU. But an IOU for what? That's the question that breaks most people's brains. The answer is nothing specific. Not gold, not silver, not anything tangible. In 1971, President Nixon ended the last connection between the dollar and gold. Before that, at least in theory, you could exchange dollars for a fixed amount of gold. After 1971, money became what economists call fiat currency. It has value because the government says it does and because we all agree to accept it. Money is belief. Money is trust. Money is a shared hallucination that works remarkably well until suddenly it doesn't. This creates a strange and fragile system. Because money is created through loans, and loans are debt, the system requires constant growth. Businesses must keep borrowing to expand. Consumers must keep borrowing to spend. Governments must keep borrowing to function. If lending stops, if everyone decides to pay off their debts and borrow nothing new, money actually disappears from the system. The money supply contracts. Deflation sets in. Businesses fail. Unemployment skyrockets. The economy collapses. This is why central banks panic whenever lending slows down. This is why interest rates get cut to nearly zero. This is why governments stimulate and inject and bail out. Not because they're generous, but because the system will eat itself if debt stops growing. Our economy isn't built on production or innovation or hard work. It's built on an ever-expanding mountain of debt. And that mountain can never stop growing without catastrophic consequences. So here's the question that should be keeping economists awake at night. Can this last forever? Can you really build a civilization on money created from nothing, backed by nothing, requiring infinite growth in a finite world? History suggests the answer is no. Every fiat currency ever created has eventually failed. The Roman denarius, the French assignat, the German papier-mark, the Zimbabwean dollar, the Venezuelan bolivar, they all collapsed when governments created too much, when trust evaporated, when the gap between paper wealth and real resources became too obvious to ignore. Some of these collapses happened slowly over centuries. Others happened in just a few years, wiping out the savings of entire populations practically overnight. The United States dollar has been the world's reserve currency for decades. It's trusted globally. It's used for international trade. Oil is priced in dollars. Debt is denominated in dollars. This gives America an extraordinary privilege. They can create money and export inflation to the rest of the world. Other countries have to earn dollars through trade. America just prints them, or rather, types them into computers. But this privilege isn't permanent. China is working to internationalize the yuan. Russia and other nations are reducing their dollar holdings. Digital currencies, both government-issued and decentralized, are emerging as alternatives. The system that's worked since World War II is showing cracks. Each crack might seem small in isolation, but together they suggest something larger is shifting beneath the surface of global finance. And here's what most people don't realize. When this system finally breaks, it won't be a distant academic problem. It will show up in your life immediately and violently. Your savings could become worthless. Your paycheck might not buy groceries. Your retirement account could evaporate. We're not talking about a stock market correction. We're talking about the potential collapse of money itself as a concept. Some people are preparing. They're buying gold, silver, Bitcoin, real estate, anything that isn't just a number in a computer maintained by institutions they don't fully trust. They're not crazy. They're reading history. And history is clear. Money created from nothing eventually returns to nothing. The truly unsettling part is that there's no easy way out. If central banks stop creating money, the debt-based economy collapses. If they keep creating money, inflation accelerates until the currency becomes worthless. They're trapped between two catastrophes, trying to navigate a narrow path that may not actually exist. Every decision they make is a gamble with stakes that include the stability of civilization itself. Right now, at this very moment, someone at a central bank is typing numbers into a computer. Money is appearing. Debt is growing. The system continues. We go to work, we check our bank balances, we swipe our cards, and it all feels solid and real and permanent. But underneath the surface, the foundation is nothing but trust, and algorithms, and the belief that paper and digital entries have value because we all agree they do. It's the most successful mass delusion in human history. And like all delusions, it persists right up until the moment it doesn't. The money in your pocket, the numbers in your account, the wealth you think you have, it all came from nothing. And there's no law of physics that says it can't return to nothing. The only question is when.